Hi guys, this is Dan from the Investment ABC, your guide to financial freedom. And in this video, I want to warn all those new investors who are extremely bullish right now and think the markets only can go up and up and up. What we are witnessing currently is not how the markets normally used to behave. The central banks of the world distorted the markets in a way that most investors get used to ever increasing stock prices and plow more and more of their wealth into the markets. Greed is at its all time high, and so is the amount of margin investors use. If we have a look at this chart, we can see how the stock market is almost 100% correlated to margin debt. Since March 2020, margin debt went up in a straight line without any significant pullback, and so did the stock market. Only recently, in July 2021, the margin debt experienced a pullback. If we look at the S&P 500, we can see that we had a slight correction from 4,481 to 4,370 before bouncing back up to new all-time highs. We don't know if margin debt has increased again in August and helped the stock market to ground higher, or if margin debt declined even further. Most investors know that the stock market is totally overvalued, but they can't sit on the sidelines and risk missing the run, especially if the run is so strong. Imagine you are a fund manager and you have missed the run up last year. You would most likely lose your job soon if you don't enter the market now. The professional money managers can't afford not to participate until the stock market starts to drop, and the retail investor is either too greedy to exit or thinks that the Fed will pump the markets until infinity, so he is slowly increasing his bets. Another group increasing its activity at the peak of a bubble are the companies themselves with the help of stock buybacks. Most of the time, the CEOs want to cash in their stock options at the best price they can get and therefore are announcing stock buybacks even when they know that prices are overvalued. These three groups will be like always buying the top. In my opinion, it is very unlikely that a bear market starts without maximum retail participation. Examples from the past are the 1929 crash, the dot-com crash, and the 2007 housing crash. In all these bear markets, easy availability of credit and liquidity slowly led to a blow-off top in prices until the Fed reduced liquidity at a time where valuations were totally detached from the fundamentals. Liquidity and easy credit is the number one reason for rising asset prices. You can almost forget everything else. As I said, most investors don't believe that the Fed has the ability to reduce liquidity anymore because the system became so fragile that it can't handle the withdrawal of liquidity. This might be true, but in my opinion, the Fed is a tool to transfer money from the masses to the owners of the Fed. Nothing more. The Fed doesn't care about anything else, so we have to observe how the masses are positioned right now. The masses are clearly believing that cash is trash and that hyperinflation is imminent and will wipe out their earnings. This is the reason why the masses are jumping into the stock and real estate market and paying whatever it takes to secure the assets. The masses are clearly indebted and overleveraged and are betting that inflation will slowly erode the debts. Though I believe this is true in the long run, the vast majority of people can't assess if they are overleveraged or not, and most people don't even think about what will happen once interest rates start to rise at some point. For the Fed, now would be the best time to slowly reduce the liquidity in the system to start a decline in asset prices. In my opinion, the market is so overleveraged and overvalued that it only needs a little bit of withdrawal for a big decline. Like I said, the majority of the investors know that the market is overvalued, so they already have one hand on the panic sell button. Smart money like Warren Buffett, Bill Gates, or even members of the Fed has already quietly exited the stock market party before everyone else. Those with their fingers on the sell button won't hesitate to press once they see the slightest dark clouds appear on the horizon. Once the stock market slowly rolls over and breaks chart structures, the traders will exit, and once the price declines even further to really cause pain, ETF holders will start to liquidate their positions, which will cause even further downward pressure on the market. Since ETFs have to sell into the market no matter what the price is, once investors are pulling their funds out, this can cause sharp declines until the valuations come sharply back down to earth at a level where value investors may want to buy again. So, when will the Fed reduce the liquidity? The Fed has already talked many times about tapering their QE programs, and they are preparing the market for it. But the first withdrawal of liquidity doesn't come from the monetary side but from the fiscal side. The US government has cut additional unemployment benefits, which helped consumers to pay their bills and keep their spending power. At times, people with additional benefits were earning more than prior to the pandemic without employment. This is the reason why many employers were struggling to find employees. In my opinion, a part of these benefits was pumped into the stock or crypto market to get out of poverty. People were hearing from friends and family members, and not to forget professional TikTokers, how easy it is to make money in the stock market. Now, when the benefits are gone, people won't have enough discretionary income to either put into the stock market or buy goods and services which aren't really necessary. This will negatively impact the earnings of many companies. Furthermore, many companies will struggle to pass on higher input costs for their goods and services to their customers at a time where inflation is running hotter and hotter. If that is not enough, many smaller businesses like restaurants around the world are being pushed by their governments to only service vaccinated people. The countries around the world are more divided than ever, and these actions won't change any minds. It will only lead to more and more bankruptcies of small businesses. Those who aren't vaccinated will most likely avoid eating outside, going to cinemas, and only buy the necessities. You will most likely see the effect of this more and more in the next coming months. Another headwind for the stock market is coming from the housing market in form of the eviction moratorium ending. The Supreme Court has ended the eviction moratorium, which protected millions of renters from getting evicted for more than a year now. More than 7 million renters are behind on their rents and are facing eviction. In my opinion, landlords won't spare the tenants 1 minute more than necessary to send an eviction letter. This crazy moratorium is one of the factors why rents are skyrocketing and most likely will rise even further. What will happen is that burnt landlords will be extremely hesitant to rent out their properties. They will triple check the tenant's background and in doubt will leave the property empty. If rents are getting even more expensive, people won't have enough to spend on the latest iPhone or gadget. Finally, the most important factor determining the direction of the stock market, the Fed liquidity, is close to at least slowing down. Goldman Sachs is raising the odds of the start of the tapering this November to 45%. If that would be the case, I'm expecting all those with their fingers on the sell button to press it. But with the Delta variant, supply chain problems, and deteriorating job numbers as an excuse, we might wait until inflation is getting even higher for the Fed to act. I'm not sure if they will act this year or sometime in the first quarter of 2022, so we have to see. Even for dividend investors, the yield for the S&P 500 dropped to almost an all-time low of 1.3%. Only in 1999 and 2000 we had slightly lower yields. The 10-year US Treasury yield is also currently at 1.34%. Should yields spike significantly higher due to an increase in inflation expectations, the stock market could take a big hit. One last uncertainty which is impacting the markets in the short term is the Evergrande collapse out of China. The market is slowly getting scared that the Chinese government won't bail the failing property developer out. In the past, China did everything to keep the asset bubbles inflated, but with the latest crackdowns on its Chinese tech companies, the government might let Evergrande fail to prevent moral hazard and an even bigger collapse in the future. Another reason why China might let Evergrande collapse is that it has acquired significant gold reserves over the last decade to cushion the financial impact of such a bankruptcy. We will see how things play out here over the next weeks, but in my opinion, chances are high that the Chinese government won't help out. Many investors believe that the markets will have one final blow off top before collapsing, but somehow I can't see this happening. In my opinion, the market will roll over from here and already topped, or we might go sideways for 3 to 6 months before entering a bear market. I am extremely hesitant to enter the market with new longs, especially when buying ETFs. I think stock picking is a smarter play than investing in the broad indexes. Check out which companies will do well over the coming years and build your positions over time. Increasing the cash position and having an allocation in precious metals will also help you to sleep at night. Unfortunately, I wasn't able to complete this video earlier, but I have been saying that the market is flashing warning signs despite the technical picture looking strong. The Nasdaq Composite was breaking to the upside out of a rising wedge formation only to break back down soon after. The chart now looks like we might have a test of the upper trend line in the next 2 weeks and then fall to around 14,200 where we have strong support. If we break 14,200 to the downside, that would be extremely bearish and would most likely signal a bear market. If you liked the video, hit the like button to support the channel, share this video, follow me on Twitter for more timely updates and comment your opinion. Is the market going down from here or will we see another melt up like a lot of people think? Bye guys and see you in the next one.